It's a Tuesday morning in March of 2026, and Frank Delaney is standing at his kitchen counter in Zanesville, Ohio, holding a mug of coffee that's already gone lukewarm because he's been staring at the same envelope for 10 minutes. The radio is playing low in the background, some morning show host talking about the weather turning warm this weekend. Frank is 68 years old. He retired 2 years ago after 31 years running the parts counter at a farm equipment dealership. The envelope in his hand is from the Social Security Administration, and it's not his usual benefit statement. It's a notice telling him his Medicare premium is going up. Way up. Not because he did anything wrong. Not because he got sick. Because of a single decision he made 14 months earlier when his accountant told him it would be smart to pull a little extra out of his IRA. Frank set the coffee down. He read the letter twice. Then he said, out loud, to an empty kitchen, "How is my health insurance connected to my retirement account? I need you to understand something right now. Frank Delaney is not a character I made up to scare you. Frank Delaney is a stand-in for millions of Americans who are getting hit with this exact same shock, this month, this year, in kitchens just like his, in every state in this country. This is happening right now, to people who did everything right, who saved responsibly, who trusted that the system was designed to reward that discipline. Here is the hook, and I want you to sit with this for a second. Your Social Security, your Medicare premium, and your income tax return are not three separate systems. They are one single interlocking machine, built quietly over decades by Congress, that uses your own retirement income against you. And it is specifically designed to punish the exact behavior every financial advisor in America has told you to do for the last 40 years, which is save more, withdraw carefully, and try to build a nest egg. For the next few minutes, I'm going to show you exactly how this machine works, gear by gear, dollar by dollar. And then I'm going to show you how to take your hand out of it before it costs you everything. Frank Delaney is about to lose. Before we go further, I need something from you. If this is making your stomach turn a little, hit that like button right now, because it tells me you're still with me, and it tells me this story is landing. And I want you to do one more thing. Down in the comments, right now, tell me your age, and whether you've started taking money out of a retirement account yet. I read every single comment. I'm not exaggerating. This isn't a broadcast, it's a conversation. And the comment section is where I find out who I'm actually fighting for. Now let's get into the math, because this is where the trap actually shows its teeth. Before Frank pulled that extra money out of his IRA, his financial life looked simple. He and his wife Carol collected $42,000 a year in combined Social Security benefits. They had about $18,000 in pension income. Under the rules that have governed Social Security taxation since 1983, none of this looked dangerous on its own. Here's how the IRS decides how much of your Social Security benefit gets taxed. They calculate something called provisional income, which is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefit. For a married couple filing jointly, if that provisional income number stays under $32,000, none of your Social Security gets taxed. Between $32,000 and $44,000, up to 50% of your benefit becomes taxable. Above $44,000, up to 85% of your Social Security benefit gets added to your taxable income. Frank and Carol were sitting right around the edge of that middle bracket, manageable, survivable. Then Frank took $22,000 out of his traditional IRA to help their daughter with a down payment. That single withdrawal did three things to him simultaneously, and this is the part nobody explained to him ahead of time. First, it pushed his provisional income well past that $44,000 threshold, which meant 85% of his Social Security benefit, instead of a smaller portion, became taxable income. Second, that same $22,000, combined with the newly taxable Social Security, pushed his modified adjusted gross income, the number the government uses to calculate Medicare premiums, above the 2026 IRMAA threshold of $109,000 for an individual, $218,000 for a married couple filing jointly, if we're looking at their combined return. That word IRMAA stands for Income-Related Monthly Adjustment Amount, and it is a Medicare surcharge that kicks in automatically once your reported income crosses these lines, and it is calculated using your tax return from 2 years earlier, which means Frank had no idea it was coming until the letter showed up. Third, the extra taxable income pushed part of his withdrawal into a higher federal bracket than he expected, because the standard 2026 Part B premium of $202.90 a month is what everyone pays as a baseline, but once you cross that IRMAA threshold, that monthly premium jumps. And at the tier Frank landed in, his new combined Part B and Part 500 surcharge added roughly $2,300 a year to his household's Medicare bill. on top of the extra federal income tax he now owed on 85% of his own Social Security check. Layer those three things together: the newly taxable Social Security, the higher federal bracket, and the Medicare surcharge, and Frank and Carol's single $22,000 withdrawal cost them somewhere around $6,000 in the first year alone. And because IRMAA is reassessed using a 2-year lookback, that surcharge doesn't disappear after one bad year. It follows you. If Frank doesn't manage his income carefully going forward, that $6,000 hit compounds year over year for the rest of his retirement, quietly draining tens of thousands of dollars that he thought was safely his. I want you to think about your own IRA statement for a second. Down in the comments, tell me the size of your retirement account and whether anyone has ever explained the word provisional income to you before today, because I'm willing to bet the answer is no. This comment section is the field hospital for people just like Frank, people finding out for the first time that the system was never neutral. Now let's talk about who built this, because it was not an accident, and it was not incompetence. The taxation of Social Security benefits was created by the Social Security Amendments of 1983, signed under a bipartisan deal shaped by the Greenspan Commission, at a moment when the trust fund needed a cash infusion. Congress set those thresholds, that $32,000 and $44,000 cutoff for married couples, and they never indexed them to inflation. Not once, not in over 40 years. A threshold that felt generous in 1984 has quietly strangled more and more middle-class retirees every single year since. Because wages and cost of living have climbed while that number stayed frozen in amber. Then in 1993, Congress raised the cap again, creating that 85% inclusion rate, specifically to fund Medicare. And IRMAA itself was created by the Medicare Modernization Act of 2003, expanded further in 2010, layering a second income-triggered surcharge directly on top of the first one. Groups like the Congressional Budget Office have flagged for years how this frozen threshold quietly pulls more and more retirees into taxation every single year, simply through what's called bracket creep, and Congress has left it untouched because untouched means revenue. The government collects tens of billions of dollars a year from the taxation of Social Security benefits alone, money that flows directly back into the same trust funds these thresholds were designed to protect. This was not an oversight. This was left in place on purpose. Which brings me to something you need to do the second this video ends. Think of the person in your life who thinks they're fine because they paid off the house. Think of the widow down the street who hasn't touched her husband's old 401k because she's scared to make a mistake. Think of your brother who keeps saying he'll deal with his retirement accounts next year. Send them this video today, not tomorrow. Because if they take one wrong withdrawal without understanding this machine, it could cost them anywhere from $3,000 to $10,000 a year, for years. That is not a hypothetical number. That is Frank Delaney's number, and it is happening to someone you know right now. Here is how you get your hand out of the machine, and I'm going to give you 5 specific moves. The first is called bracket fill Roth conversion timing. In the years between when you retire and when you start Social Security, or before you turn 73 and required minimum distributions kick in, you convert traditional IRA money into a Roth IRA in careful amounts, filling up your current tax bracket without spilling into the next one, and without crossing IRA thresholds. In Florida, with no state income tax, a retiree can convert more aggressively because there's no additional state tax bite. In Ohio, retirees get a partial retirement income credit, but still face state tax exposure on conversions, so the fill has to be calculated more conservatively. In California, with some of the highest state tax rates in the country, that same conversion can cost thousands more, which means Californians often need to convert smaller amounts over a longer runway. The second move is called qualified charitable distribution routing. If you're 70 or older, you can direct up to $108,000 in 2026 directly from your IRA to a qualified charity, and that money never touches your adjusted gross income, never touches your provisional income calculation, and never touches IRAA. It satisfies your required minimum distribution without triggering any of the 3 layers we just walked through. The third move is the SSA 44 life-changing event appeal. If your income dropped after a specific triggering event, retirement, divorce, the death of a spouse, you can file Form SSA 44 with the Social Security Administration and request that your IRMAA be recalculated using your current income instead of the 2-year-old tax return the government defaults to. Most people never file this form because nobody tells them it exists. The fourth move is asset location and withdrawal sequencing, meaning you draw from taxable brokerage accounts and Roth accounts first in years where you're close to a threshold, and save traditional IRA withdrawals for years where your income is already low. The fifth move is the standard deduction stacking strategy. using the new 2026 senior standard deduction increase to shelter more retirement income before it ever becomes taxable. Compare two identical retirees, same Social Security benefit, same IRA balance. The one who executes these strategies can keep $6,000 to $8,000 a year that the one who doesn't simply hands over. Save this video right now. Bookmark it. Put it in a playlist. Call it whatever you want. Because when that IRMAA letter shows up in your mailbox, when your CPA calls with a number you don't understand, when you're staring at your own version of Frank Delaney's envelope, you are going to need to come back and find the exact strategy that applies to your situation. This is your survival manual, not entertainment. Here's your window. The provisional income thresholds are frozen, and every cost of living increase to your Social Security check pushes more of you across that line every single year. The IRMAA brackets are indexed to inflation now, but the base income thresholds and the underlying tax treatment of your benefits are moving in exactly one direction, toward pulling in more retirees, more aggressively, with more automated enforcement, because the IRS and the Social Security Administration now share your data instantly. The years between retirement and required minimum distributions are the only real window most people get to fix this, and for many of you watching, that window is already closing. Like this video right now. Subscribe to this channel and hit that bell so you don't miss what's coming next. Comment below with your specific situation, your age, your accounts, your questions. Send this to one person today who needs to hear it. Save it to your library before you go. They built the trap quietly. We're going to dismantle it loudly, one kitchen table at a time. I'm the retirement insurgent, and I'll see you in the next one.